Welcome. My name is Renee Goodnow. I am your moderator from the Small Business Development Center. And on video with us today too is Peter Pappas. He is our presenter. During the webinar, you can type any questions that are relevant to the topic being discussed in your chat box, and we will answer those as time permits. And then at the end, we'll definitely have a Q&A for folks to answer more questions. And with that, I will turn things over to you, Peter.
Thank you and good morning. So today we're going to talk about what a business is worth, the valuation, and tomorrow we're going to talk about how a business purchase and sale deal happens. What are the elements of purchase and sale? So this is about exit strategy. Not many people have a valid exit strategy when they're in business. They don't think about it. They struggle so hard to get in and stay in business that they never consider how they're going to exit. But nobody lives forever. And there should be a plan. In the absence of a plan, there could be a disastrous exit or a forced exit, health or family issues. The business decays, the market changes, and the owner doesn't have the energy to chase it. And it's at that point, it's a little late to try and figure out a strategy to get some value out of that business. The purpose of this is to get you to think about transferring the ownership rather than closing the business. A valid exit strategy is lay everybody off, have an auction, and move to the Caribbean. There's nothing wrong with that. But to get the value out of the business that somebody has spent a lifetime building, we need to look at ownership transition possibilities. In the next segment tomorrow, I'm going to talk about how to find people to take over your business and pay you for it. Exit strategy has to be a complete strategy with not just an end goal, but an understanding of the resources and actions, the steps necessary to achieve that. If you don't have it, you have any plan with an end goal and no details is fiction. So you need the outcome and time frame, an action plan. And what's the first step? What's it worth? If you're going to transition a business, you need an idea of what you have to sell, what's its value. And I've met a lot of business people, and I've been in business, and I've heard a lot of myths about what a business is worth. And I'll explain in a few moments how what it's really worth. But if you're exiting, you want a fair price, you want top dollar. And I've got to put in a little commercial here for the SBDC. I used to be an SBDC counselor in Connecticut many years ago. And their help is invaluable. They're not going to do the job for you, but they're going to give you the guidance to get the job done. An exit strategy happens usually only once in a person's lifetime, but SBD counselors have resources that have, like me, that have been through this many times. They offer autonomy and impartiality. They have nothing at stake except helping your business. I was asked once when I was helping both the buyer and the seller in the transaction, the accountant said, well, who do you represent? I said, I represent the business. My job is to develop small business, and I'll work with whoever I think I can help do that. The SBDC offers confidentiality, huge confidentiality. Under the Code of Federal Regulations, the SBDC is independent of every other federal agency, even the SBA, which it is funded through. This is important. A business owner can tell an SBD counselor anything, and they're not going to report that person. They're going to help them get into compliance, tax compliance, labor compliance, without harming the business. In other words, folks, that means they're going to help bygones be bygones. Now, If you open the refrigerator in your office and there's a severed human head in it, the counselor's going to tell somebody. But pretty much on business activities, you can rest assured you can share anything with them and they will help and not turn you in. They have resources. They're usually affiliated with a major educational institution with all those departments of engineering, business, whatever, and they can call on the professors in those for advice. They have affiliates. They work with banks, lenders all the time, and technical experts. They can direct you to engineers, architects, whatever you need. End of commercial. Now, why would you want a valuation? There are many reasons I've encountered in my time doing this, about 2 decades. The easy ones are an owner wants to know, hey, what's this worth? I've worked myself to the bone for 5 years. What have I got? An exit strategy, what we're talking about in this series of seminars. A partnership change. A partner wants out or a partner wants in. Well, what are they buying? What are they selling? They're selling a partnership interest. We value the whole business and then figure out what their interest is worth. And we'll get to ownership control and the difference later. A lender or investor may say, well, what is this worth? Will the value of the business cover the loan? And then there's the legal things such as estate execution, divorce, partnership dispute. Now you may think, Pappas doesn't want to get involved in this kind of thing. Well, I'll help you. I'll give you a starting point. And let me tell you about valuation, the truth of it. And you can probably hang up after this if you don't feel it's worth it, but it is. I've been doing this 20 years. There are people who do this professionally. And I would do a valuation for a couple $100. They would charge a couple $1,000 for a multi-page valuation to bring to court. And you know what? The opposing attorney is going to only need 5 more minutes to tear theirs apart than mine, because the truth is that the only true value of a business is what it sells for. It's very hard to stand here and say, this business is worth X, and it's on the market. I've done that many, many times, and I have to tell you that at no time was the selling price exactly how I valued it. Sometimes it was pretty far apart. I had one client who had early stage dementia, and she needed to bail. She had a buyer, and she took what she could. It was about 1/3 of what I said the business is worth, but everybody was happy. Her exit strategy was rather urgent. What I'm showing you how to do today is get a starting point for any of these issues. Something you can use to sell your business. Everybody wants to know how much when they go to buy something, be it a can of soup or a car. So you need to have upfront an asking price, and that's what we can develop. And from then on, there's going to be a bit of negotiation, give and take. A business, no matter what you say, it isn't it is an investment. People buy a business for an expected return and no other reason. There are some fools who just want a business, but what they should be paying for is as an investment, capitalization of the return on the investment. And you see down here the stock certificate. Well, that's called price earnings ratio, a capitalization of return. In bonds, it's called the yield, capitalization of return. And in real estate, it's called simply the cap rate. The building nets $100,000 a year. The cap rate is 10. It's worth $1 million. Always a return on investment, the value of the capitalization of the return. Any investment. Here's the formula. It's in your handout, so don't scribble it down. The capitalization multiple I told you about times the current return. That's the simple part. Then there's the adjustments, growth, the present value of future growth. Any business debt assumed by the buyer reduces the value of the business. Any cash or equivalent assets increases the value of the business. And in some businesses, inventory is a cash equivalent because it's going to be sold rapidly, such as a restaurant. Good sellable food on the shelf is cash, is basically cash in one form being waiting to be turned into cash in currency within a week. The value of the business is irrelevant of the asset cost or current value of the assets, with few exceptions, notably real estate, a possible exception. I had somebody come to me and he had a fitness center and he had somebody wanted to become a partner. She wanted to buy 20% of the fitness center. And he said, what's it worth? And I valued it based on capitalization rate of the return with the adjustments. And I said, your business is worth $85,000. And he said, but I just spent $100,000 on new equipment. I said, well, then sell the equipment. The equipment is only in aggregate earning. It created a business that's worth $85,000. This is not unusual. So the capitalization rate, and I'll show you how to find capitalization rates for business types. It's based on how secure those future returns are. I give the example, a painting contractor's assets, his production assets, go home every night. The painters that he employs are pretty flexible. So the value of a painting business, the capitalization rate, won't be as high as for, say, a marina on waterfront property where there's very few opportunities to compete. There's only so much waterfront property that's suitable for a marina. There are factors of the stability, the historic stability of the type of business, the market and competition, that particular type of business. The capitalization rate assumes that there'll be a successful succession. And each business category has its own systems. If you're buying a business, you need to look at what its strengths are, not what you think you can improve. Very dangerous to try and change a going business that's established a market. You can chase away the people who are in that business, who are patronizing that business by robbing them of the consistent results they were getting. Mostly the capitalization rate has to do with the type of business, and there's rules of thumb on capitalization rate. This is the book I use. This is the book I tell the SBDC programs to get, and I know New York has bought it here and there, and they have access to it. And I'll show you in a moment what it's like. First, it'll give you the capitalization rates, and then 2 to 5 pages of discussion on how this business operates, what the general rules of thumb on things like cost of goods sold, labor, rent, whether the industry is increasing or contracting, what kind of competition. Competition, I mean dissimilar alternatives. There's always alternatives to any business solution. I say businesses sell solutions, not products and services. So the rule of thumb in that book assumes that the customer base is stable. The competition is stable. And that there are no hidden violations. And some businesses are inherently difficult environmentally, such as a dry cleaner, a printing press, a oil change facility. If you are thinking of buying or selling one of these, look into the environmental issues to make sure it's clean. There's 3 phases of environmental. Phase 1 looks at the records, and that's pretty cheap. because any environmental violation is recorded, believe me. Phase 2, they actually do sampling. They drill into the earth to make sure that the dry cleaner didn't discharge any perchloroethylene into the water supply. And phase 3 is when they actually do remediation. That's the expensive part, and you never know how much that's going to cost until you get into it. The law also, compliance with the law means land use and regulation. If you're buying a business, go to town hall and ask what zone it's in and whether it's a permitted use, or whether this particular business is grandfathered and on sale, they would no longer be allowed to operate. People at town hall are very helpful, and the most helpful is the development department. Every town, every city has somebody in charge of economic development because it brings in taxes and jobs. It may be part of the job description of the first selectman. It may be a separate person. Here in Tucson, Arizona, we have a whole department of 5 people doing nothing but trying to build the tax base of this city. Finally, there would be no pending infrastructure change impact, such as a highway bypass that will turn this road into a ghost town. Another assumption is control. I told you that control is important. The rule of thumb assumes that control passes completely. We're 100% control. And control, I'm getting into this a little more later, but control is 51%, but a minority interest still has some say. So 100% is what the rule of thumb assumes. If you have a minority interest, such as that woman that was going to buy 20% of a gymnasium, she should enjoy a big discount of that $85,000 times 20%, because she's going to have no control. That the business is marketable. There are many restrictions on the marketability of a business, starting with a bank loan. In every loan document, there's restrictions on transfer of ownership. Sometimes major suppliers will extend credit based on the condition that there's no change in ownership. So if you're going to start an exit strategy, you've got to look at these things and clean them up. If you tell your banker you want to sell the business, he's not going to say, oh, no, you can't. He's going to explain what you need to do to satisfy the bank's needs and still let the business transfer. No trapped-in capital gains. Well, what's that? That's when an asset is on the books for a lot less than its value, meaning that eventually when it gets sold, there's going to be a capital gain and a tax. The business owner, the seller probably knows where they are. The seller's accountant certainly knows where they are. It's not common. It's quite unusual, actually, but it can happen, and it's worth looking into. And if they're key people, will they stay? One of the issues on business purchase and sale is, when does a buyer get to talk with the employees? I have a plum of a client right now. The employees all know he's going to retire in 2 years. Best situation, a buyer can come in and meet them. I had one client in the same industry. He bought it was a medical practice. He bought the practice. The selling doctor didn't tell the employees until after the closing. Nobody likes an ambush. They all left. And essential intellectual property, that is patents, trademarks, trade secrets, they're secure and they're going to be part of the sale. I had one client, he was selling a butcher shop, famous for sausages. He said, the only thing I'm not going to sell is my family recipes for sausage. And I said, then you are selling nothing. You're just selling a bunch of refrigerated cases and equipment, because that is a sausage shop. If you don't pass the intellectual property, it's not a sausage shop anymore. It's a conglomeration of equipment. He eventually sold the recipes with the shop because he found he had to. Assets. Equipment is serviceable. That means it's all working order. or at least can be kept in working order with normal maintenance. It's within current range of the state of the art. Obsolete equipment may still make the widgets, but somebody else is going to make them a lot faster and cheaper. And it's production balanced. If you have 3 machines feeding one and you really need only 1 machine feeding one, then you have surplus capacity that's locked in. You need to balance it out for the maximum value of the business. In a lot of cases, it will mean selling off surplus, unbalanced production assets rather than trying to build out and increase the size of the operation. The market might not support it. Inventory is merchantable. It should be written off. If it's obsolete or damaged, it should be written off by generally accepted accounting principles. And it has to be appropriate for the business. The guy who's selling ice cream cones that has a big inventory of balloons because he had a promotion 2 years ago, those balloons aren't merchantable inventory. There's a process called due diligence, which happens after a business, an offer and an acceptance is made, and before the closing of the transfer of the ownership of the business. Due diligence is when the buyer can go in and take a hard look at all the books, all the equipment, talk to the people, and it's a necessary process to protect the buyer. And in that process, if some fraud is discovered, it's going to change the buyer's offer, or the offer can be withdrawn. So part of exit strategy is to make sure you can show an accurate picture of your business that will pass muster through due diligence. Now, you remember back in the beginning, the formula said capitalization rate times the return plus growth. Well, very rare is there growth figured in a small business valuation. Generally, the business is established, any growth has already taken place, any trends are already established, and in transition, contraction is more likely because, especially in service businesses, people identify the service provider with the business more than the business. A patron of a hair salon is more loyal to the stylist than the salon. And that gets into areas of non-compete agreements in service businesses especially, and I'll get into that tomorrow. Growth has to be based on fact, not, well, we've grown for 2 years, we're going to grow again. That's not necessarily true. Let's see why they were growing. Growth can happen in a roll-up. A roll-up is when a big company is buying a lot of small companies to gain market share and gain trade area. We're seeing it in the medical field right now. There are a lot of major medical institutions buying small practices to gain more market and more geographical area. If there is history, sometimes roll-ups are just competitor A buys competitor B. They've been there forever and there's no real synergy. Now, some new businesses, their value is all based on growth expectation. The tech company that has millions of customers and hasn't made a profit would be an example of this. Think Amazon 10 years ago. Think Facebook 7 years ago. These companies have a huge market, haven't made money, so there's no return to apply a cap rate to, but there's tremendous growth potential. Those are called unicorns because they're very hard to find. In my 30 years of doing this sort of thing, I've met one, maybe. I don't know the outcome. He had potential. But for most businesses, growth is not a factor. Return can be measured as profit, earnings before interest and taxes, earnings before interest, taxes, depreciation, amortization, also in the old days called cash flow. and seller's disposable income, which is the one I use the most because it, in effect, is saying, this is what the seller is enjoying. This is his compensation package. This is what a buyer is really buying. It's the best measure for small business, but it's a little hard to figure. We start with tax returns because people are very unlikely to falsify a tax return, much more unlikely to falsify a tax return than internal documents. But remember that tax returns are prepared for the single purpose of avoiding tax. So there's a lot of things the accountants use, including accelerated depreciation, accruals, and so forth, that reduce the apparent profit and therefore the tax. Any savvy accountant can put this back together and say, okay, we can figure the SDE by changing the depreciation schedule, eliminating the accruals. Some businesses accrue a huge amount of expenses at the end of the year. I remember one business, all expenses from January were accrued back to December. They did that year after year, and it only worked once. So it was really not a good practice. I always say engage the accountant early on. If the seller's accountant can be made available, explaining the tax return, very helpful. The accounting system is less reliable, and the tax returns are less reliable because of off-books SDE. Let me tell you, everybody who owns a business is feeling from it. It happens, it creeps in. I had one lady come to me and she was operating a restaurant and amusement park. And I asked her about SDE and she said, oh, I'm squeaky clean. I said, really? You never let your friends into the amusement park for free? You never eat in your own restaurant for free? She said, oh yeah. It creeps in over the years. It becomes part of the fabric of the business. And a seller needs to be able to bring that out. And it's hard to do. I'll show you why. It's monkey business. It's hidden mischief. It can happen anywhere. Very common, the accountant does the owner's taxes for free. I've seen insurance agent pays for the owner's home and auto by increasing the premium on the business liability and casualty insurance. Business hires a contractor to paint the building, and oh, by the way, paint my house while you're at it. Business helps owners, friends, family, charity. The business owner is diverting profit to SDE, but it's hard to quantify. Now, in a family transition, the kids know the monkey business and they might want to enjoy it after mom and dad sell the business to them, so it might stay. This is the only case where I think that monkey business doesn't need to be a real issue. So, and it can be anywhere. I talked about hidden sales. Some people take cash for sales. I knew a dentist who worked on Saturday and he worked alone. He took only cash for his services at a discount. It was very lucrative. Employing family deadwood. I give my nephew a job. He's worthless, but if I don't give him a job, he's not going to get a job and he's going to be on the street and I don't know what's going to happen to him. Well, that's very noble, but after the transition, if you do an exit and the nephew stays, he's going to get sacked. So you're not doing him any favors. What you really need to do is get him responsible and move on. Sometimes the owner lives on company property. Very common. Lives above the store, lives above the funeral home, lives in a place that's part used for service to the business, and the other part is his apartment. How do you quantify these things? It's really difficult. So SDE is the total cost of the owner's compensation package, all these things, and it's going to be hard to quantify, especially totem privileges. Nobody keeps a record, a detailed record of what they took from the business. Now, these components must not be necessary for the business. If they're necessary for the business, they're legitimate owner compensation. Here's the hard part. Are they quantifiable, and is there an audit trail? Can we show a buyer what they are and where they come from? Remember, they're a trade-off as part of the owner's compensation package. We turn profit into owner's compensation. And tax treatment is another story. Yes, it's illegal to avoid taxes, to evade taxes by understating income, but it happens. And the owner's compensation can't come from outside the business to be counted as part of the value of the business. So we could develop a pro forma and try and get the SDE back in the bottom line. And here's an example of how it could be done. We add back the owner's, we deduct the owner's totem privileges from cost of goods sold. We add the kid who works free off the books to the labor, and we take off the amount that the business pays for the owner's home maintenance. And we get a book profit of $35,000, a pro forma of $48,000. Notice I'm showing profit, not SDE, only for the simplicity of this example, because there's a much better way. If you're going to sell the business right away or transition the business to buyers right away, all you can do is a pro forma, and the best you can do is try and start quantifying all the off-books SDE. But the buyer has to understand what you're doing. If you say, well, the business is really worth this because I'm getting that off books, the buyer has to be able to understand how that works and be able to understand how you're quantifying it. Better still, stop the monkey business now, market the business in 3 years. You'll have 3 years of accurate business presentations for a buyer. People say, well, I don't want to get caught. If all of a sudden my income goes up, the IRS is going to notice. Probably not. If you're paying reasonable taxes, and it might have a leave it in Las Vegas strategy. Bygones are bygones, and SBTC counselors can definitely help achieve this with full confidentiality. If you're going to go on this route of eliminating SDE and getting it on the books, a business owner sometimes isn't even aware of off-books SDE. It's been going on for so long. So here's a page out of the book. This is the head of the section on restaurants. It goes on for a number of pages describing restaurant statistics, the industry, and so forth. It's a very helpful book. So the cap rates that it's giving for full service restaurant, 20-35% of annual sales plus inventory, 1.5 to 2 times SDE plus inventory, so on and so forth. But notice that inventory is a cash equivalent if it's merchantable. I'll talk to you more about restaurant inventory or high throughput inventory valuation. So if we have an SDE of $250,000, we go to 2 times at the high side, and the business asking price is like $500,000. The asking price should always be on the high side. You can always go down, but it's very hard to go up in negotiating. The book has franchises. How simple is this? 40% of annual sales plus inventory. Inventory again. Why? Because the interesting characteristic of a franchise is they are so identical in operation that we can figure out what they should be making based on sales alone. Franchises are extremely consistent. That's their advantage. So inventory is a cash equivalent again, and it varies greatly depending on timing. because of this. The reality is that inventory increases when the supplier delivers it, but the cost is not booked for some time and it isn't paid for some time after that. So in the case of buying a restaurant, there's no substitute for doing a physical inventory at the closing to figure out what the inventory is worth. Now, any seller who's been with me so far in this presentation can think, well, if I increase my return, I'll increase my value. There are some deceptive things that do that, deferring maintenance, cutting staff, which cuts service and doesn't impact sales for a while. Reduce employee benefits, which drives employees to other employers, but not for a while. You can relax your credit policy and sell huge amounts to deadbeats who are never going to pay you. And that goes on the books, looks good for a while. You can sell down inventory, operate on lower inventory that will impair the business ability to fulfill the customer's needs after a while. Book investment as sales. I've seen this. A lady was selling a pet shop, and all of a sudden her sales went up and her profit went up $25,000 in a single year. And I dug into it. She had maxed out her credit cards and put it in the business as sales. That only works for a while. And all these things are going to be discovered on due diligence and either kill the deal or modify it severely. Now, real estate can complicate the deal. If the real estate and the business are inseparable, they cannot be valued separately. The value of the business and the real estate combined is a capitalization of the return. If the real estate is worth more than that, then the business is worth more dead and alive. Sell it or move it and sell the real estate. Usually real estate is separate from the business. The owner holds it in a separate entity such as an LLC. But the return on investment on real estate, the cap rate, is always higher than for a business. I'll give you an example in a moment. Most businesses, the owner owns the real estate separately and pays rent to himself. That's more than moving money from one pocket to another. Rent is passive income as opposed to salary. There is no Social Security, Medicare, tax on passive income. There's no workers' comp requirement on passive income. It saves a load of money. So let's talk about the restaurant example again. It was worth $500,000. He owns the real estate. The restaurant pays no rent. They're bundled. That's in the example I showed you. It's worth $500,000. Now we carve out the real estate. The business owner pays him $50,000 a year on rent, dropping the SDE to $200,000, dropping his valuation to $400,000, $100,000 less. But commercial real estate in this market has a 7.5% cap rate. His real estate is worth $375,000 for an aggregate of $275,000 more than the real estate combined. This example assumes that the business pays all the costs for the real estate, taxes, insurance, maintenance, etc., to get that $50,000 net. But if the real estate was combined with the business would pay all those expenses anyway. You can get the real estate cap rate from a commercial real estate broker or lender. A lot of times the listings disclose a cap rate. There are alternative approaches to the income approach, or the net return times capitalization rate. Comparable sales, that's great for real estate, but there aren't many comparable sales for business. Businesses are pretty unique, whereas in a certain school district with a certain number of rooms and bathrooms on a certain size lot is worth pretty much the same as a house with those same attributes. Businesses are unique. They have individual market strengths, intellectual property, and culture. There are other valuations out there, assessor's valuation. Any published data has some value, but not much in this case. Book value. I've seen book value work in minority transfers of minority interest in estates. Replacement value. It's a high limit and an insurance value, but it really doesn't work well for valuing a business. And there are professional appraisers. Remember what I said, these guys will cost a lot more, produce a lot more paper, seem a lot more credible, but their guess is no better than mine or yours now that you've learned how it's done. So now we can open it up to questions.
One of our advisors says one tool they've used refers to the projections and valuation as cash flow based valuation. Is this similar to anything you have discussed?
Yes, that would be EBITDA, earnings before interest, taxes, depreciation, amortization. And in the book, valuation book, we have an example in the restaurant business, 2 to 3 times EBITDA. So in cash flow, that would work. But if cash flow has the same problem with SDE, that off-books compensation that is really cash flow but diverted. So yes, there usually is an EBITDA equivalent, and cash flow is a valid basis for valuation.
Have you dealt with business brokers giving clients or sellers outrageous valuations on their business?
Yes. Yes and yes. Unfortunately, I managed to tell the business owner that they're sitting on a gold mine, sign on this contract for listing, and the business sale goes nowhere, or they end up getting an offer that looks like a low ball, but it's really more of a correct valuation. The best thing is to get a valuation, go to your SBDC counselor and see if he can help. And I have a deal with the SBDC nationwide that any one of them can call me and I'll give them a 15-minute valuation based on if they can gather the data. You see what I said? They gather the data. So they do the heavy lifting and I come in at the end and I'm giving them a number of valuation. So get a valuation before you talk to a broker so you know if you're being sold pie in the sky.
Can you please comment on tech business valuation?
The tech business valuation, as I mentioned when I talked about growth, that some tech businesses are not making a profit, don't have a return, but are launching and have a tremendous market. So a lot of tech businesses will say, this can have a great market, but Amazon and Facebook already had millions of customers. They weren't making any money, but they had millions of customers. Those are the ones where you can base a valuation based on future growth. But if a tech business is launching and claims they could have, then they really aren't worth anything until they get to either a good number of customers in the market or are profitable. And it's hard, as I try not to judge concepts when I meet a new business, because I would not want to be the person that sat in front of Bill Gates when he was first pitching Microsoft and said, "Nah, I don't know." So I try and be optimistic and say, "Yeah, okay, tell me what you are going to do for the value. So a tech business depends a lot on the sophistication of the owners, and not just in tech. As we've seen many times, they need sophistication in tech and they need sophistication in business. And if they don't have both, they're going to collapse.
This person is a service business considering the ESOP or selling a portion of ownership to a few of our top long-term employees. Are there major differences or additional considerations you can speak to for these scenarios?
Yes, first of all, how can they pay for it? I've worked on these deals. Usually the ESOP is complete. They sell the business entirely, maybe not immediately, but over time, as part of an exit strategy. If they're planning to cut in employees as ownership, and that's very common in tech businesses, where they have very valuable employees who are essential for development of the product. Company isn't making money, so they can't afford to pay them what they're worth, but they can give them a piece of the action. If you're gifting, fine. If you're expecting to sell ownership, then the question is, how does the employee pay for it? And for a deal like this, you need an attorney, an SBDC counselor. It's not going to take you all the way through this. You need at least an accountant who says, yes, I understand how this works. And maybe the accountant you have is going to say, let's call in Joe, the tax attorney, to look at this too, because there are some serious tax considerations on an ESOP.
Okay, great. You mentioned materials that they could bring to their advisor to do a consult with you. What materials should they provide to get that evaluation?
The regular financial statements. If they want to bring tax returns, that's fine. Balance sheet isn't as necessary, but it's a good idea. But definitely an income statement, perhaps an internal one in addition to the tax return. And they should also come clean up front about what monkey business is going on, what off-books SDE or profit diversion they are engaging in. The counselor can't turn you in, and he can certainly help you, or she. But all the financial information you can bring to the initial meeting will really help. Otherwise, the initial meeting is going to be, okay, good to meet you, now come back with all your financial information.
How receptive are banks to considering SDE adjustments when a buyer is paying for hidden value?
If it can be documented, if there's an audit trail, they are very receptive. And even more receptive are the non-traditional lenders, economic development motivated lenders who do unbankable deals. The bankers know this. They're not in an ivory tower. They're dealing with real world situations all the time. They know that a business is more likely to have monkey business or off books SDE than not. And they will understand it if you can document it. If you just say, well, I'm actually making this much more, the banker's going to say, yeah, show me. So that once again, it's hard to establish an audit trail, but that's what you're going to have to do if you're going to impress a bank with hidden profit.
Does external environment impact valuation, like a bull run or bearish situation?
Some, in that it makes investors less likely to invest. But if you have a solid business for sale, you're offering a solid value and it shouldn't impact it very much. Remember that what we're seeing on the stock market is speculation, guessing about the future. If you have a solid business that hasn't taken any hits because of the change in the economy, then it would be difficult for a buyer to say, well, it's going to go downhill because the economy is going downhill, because indeed it is not. So the purchase and sale of small business is not going to be impacted by the coronavirus as much as the value of the shares of Microsoft and Apple.
Where would not splitting the land from the business be proper?
When it can't be split because the business and the land are inseparable. I gave an example of a marina on valuable waterfront property. Those couldn't be split. You can't move the marina inland and sell the property for condos. The marina ceases to exist. So if they're integrated to the point where they can't be separated practically, and that doesn't have to be just that one example, you could have a retail operation with a terrific location that is based on the traffic, such as a convenience store on a busy corner. It would be very difficult to separate the real estate because the convenience store would not nearly have the value if it moved away from that corner. In many, many cases, the business and real estate can be separated, but at the very least, they could be separated in that the owner can pay himself rent. And I showed you how that jacks the value of the aggregate quite a bit. That's one of the few examples of where asset value can be added to business value. And that's only because of the difference in the cap rate between real estate and business.
We had a question going back to selling to employees. If there is enough profit or SDE, can the business pay for the buyout over time? Are there any differences in the valuation process when selling to employees, either via ESOP or other method?
There's no difference in the valuation process. We could arrive at a starting point. It will always be negotiated between the owner and the employees. It will be influenced by what they can afford. In theory, a business can't buy itself because its profit is not going to be sufficient to cover the cap rate. Employee ESOPs are structured over time, and yes, they can buy themselves. Almost always, there's a need for outside financing, and the difficulty in that is who is the borrower? If all the employees are going to own it, the bank's not going to want to do credit checks and create a loan document for 20 people. There's usually going to be a situation where some people will have to step up and be responsible and therefore more powerful management. It's like George Orwell's Animal Farm. At the end, it said all animals are created equal, but some are more equal than others. So there's going to be a division in the hierarchy in an employee stock ownership plan if there's outside financing involved.
We had a question on real estate valuation. They wanted to clarify, they thought it was NOI divided by cap rate, not multiplied by cap rate.
Yeah, it's multiple. Yeah, if a business has if a piece of real estate, rental property has a net income after all expenses of $100,000 and the cap rate is 10, then it's worth $1 million. So it is multiplied. Cap rate of 10 is about average nationally.
Is there a particular way to evaluate the value of a professional services firm, for example, an architectural service?
Yes, and that brings me to my problem. I'm a one-man show. If I were to sell my business, I don't know how I could do that unless I found a clone of myself who had the same skills and didn't have a market that I have. The architectural firm, if there's more than one architect, you're way ahead of me because you have something to transition. The most valuable thing of any business is its customer base, and you could look at where you get your customers, whether a lot of them are coming from repeat customers or referral customers. That means you've got a solid base that you are able to sell. If you're doing one-time deals for people you never meet again, your market is a little more volatile. So part of the process for exit strategy is packaging that business so it's independent of the person who's selling it. I worked with a guy recently. He was ran an engineering firm in New York City. Whenever they rehabbed a building, they called him in, or one of his competitors, to redo all the mechanicals in the building up to code. They had quite a few people and they had quite a bit of expertise, and it wasn't all the principal. In order to sell a business, any business, the owner has to be able to get out of it without harming it. It has to transition to working without him. And that's something to start working on. And this person may be, with this architecture firm, may be thinking of retiring. And that's an easy one because it's something you can tell everybody without them worrying. If you say, I'm going to open another firm, that's more problematic. But packaging any business so that it can operate without the owner is an essential first step. And in service businesses, it's a bit harder.
How do you value trademark?
Yeah, the value of the trademark is what somebody else would pay for it. Well, I've had trademarks, and a trademark coupled with the business has a lot more value than a trademark floating in space for somebody. Nobody's going to buy a trademark unless they're in the similar business or want to operate an identical business. So the trademark adds value to the business or shores up the value or is part of the value of the business, but very seldom do they have separate value. A patent can be licensed. Trademark can be licensed, but by licensing a trademark, you are in fact creating competition under your brand, which is not a good thing. When you license a patent, nobody knows. They use it for their process, and it does not necessarily compete. So the answer, once again, is the trademark adds value to the business, but generally doesn't have value standing alone.
We've got lots of great presentations. Thank you. This was super helpful from a lot of folks on here.
Okay, very good.
Thank you, Peter.